Good morning. I'd like to call the meeting to order and acknowledge that we are in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Innu, and Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Ian Mann, and joining me on the panel today are Mr. Ryan Fletcher and Ms. Kira Penner. The assessment department personnel is Mr. Clayton Deitchen, and the administrative personnel is Mr. Francis Villanueva. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the Board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the Board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony, followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all of the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all of the applications have been heard, and the Board will deliberate in private to make its decisions. You will receive the Board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We will be hearing items 1, 3, 4, 6, and 7 on our docket today. Mr. Villanueva, will you please affirm the assessors and the applicant's testimony?
Of course. Mr. Assessor, please state your full name.
Clayton Deitchen.
Thank you. And do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Perfect, thank you. Mr. Applicant, please state your full name.
Dan Capust.
Thank you. And do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Perfect, thank you.
Thank you. Then, Mr. Deitchen, if we can turn to number 1 on the docket, please. That is the street address of 54 Barnes. Would you please introduce the property and provide your evidence? I believe from the docket that the sole issue to be determined is the valuation.
That's correct.
Thank you.
Okay, so this one's file 26-2448. Roll number 03099 or 030930100270. And the address is 54 Barnes Street. The assessed value is at $19,264,000. It's built in 2021. Has 68 suites, and I actually have a recommendation for value here. It will be using an NOI of $834,577 with a cap rate of 4.8%, bringing the value to $17,387,000.
Sorry, $17,387,000?
Yeah, that's the one.
Okay, thank you. Mr. Capust, have you, were you aware of this offer, or have you had a chance to consider it? Sorry, you're muted, Mr. Capust.
Apologies. Yes, I was somewhat aware, but I think I'd still like to proceed with the hearing.
Fair enough. Mr. Deitchen, then, if you could proceed or continue with your presentation and your evidence, please.
Then just continuing on to page 3 of my brief, you could see the map view and the exterior view of the subject property. Page 4, you could see the income value breakdown. So 68 units at $1785.98 per unit. You can see, well, I had adjusted this with my recommendation, but the NOI that we have is $924,670 at a cap of 4.8%, brought the value to $19,264,000. Continue on to page 5 is just my rent comparables. You can see I have 5 that I tried to get in the area with similar effective year builds, sweet mixes. You can see the range is about 1755 to 2109 per unit. And the subject falls in that range. Then continue on to page 6 is just some comparable sales that we included for newer builds. There's 4 of them, and they range from $265,000 dollars per unit to $322,000 per unit. You can see below this table that I wrote, the subject is at 283,000 per unit and a square foot rate of 322. So it falls in the range of those sales as well. Continuing on to our cap rate table. This is our standard cap rate table showing the 20th to 80th percentiles. Continuing on to page 8 is the Municipal Assessment Act information. And then on to page 9 and forward is the income and expense mailer, or sorry, page 9 to 12 is the income and expense mailer. Page 13 is just the permit for the new construction. And then page 14 and forward are the pictures of the subject property. And that is my evidence. Thank you.
Thank you. Mr. Capus, any questions?
Yes, just a couple, please. Excuse me. Go to look at page 4. I guess in your verbal offer there, you did adjust the rent, I believe, a bit, but this one here is just a model-driven number, correct?
That's correct. Yeah.
Yeah, and so I guess you did adjust it. Okay. So yeah, I guess you do review these, and if you think it's too high, you are able to adjust if you think it's required.
Oh, yeah.
Yeah. Okay. And then staying on the rents, page 5. I think you had noted that you tried to find ones with similar suite mixes, but I think all the comparables are heavily weighted to 2 bedrooms, where the subject is weighted more to 1 bedrooms. Would that impact, if you're calculating average rents, would that maybe push those average rents higher on those comparables?
I would say slightly. Yeah.
Yeah.
Okay.
I think I just did a quick average of the. I think that the subject works out to over $2, just over $2 a square foot, and the comparables are around 160, 170. Do you think that's a bit too high for the subject?
Well, that's why I adjusted with my verbal recommendation.
Okay. And then on these comparables, I guess for this property and in general, you do consistently do this gross floor area divided by the number of units to get a gross floor per area, but do you look at the comparables and try to see if they all have similar amounts of common area space to the subject?
Not really. No, I don't have time to kind of look through all the common areas, but I know that does include it, and sometimes it can kind of skew the numbers.
Okay. And then moving back to page 4, for your cap rate selection of 4.8, what would drive the model to put this building outside the 20 to 80th percentile range there? What are the factors that would cause that?
I mean, I can't really speak to the model. I don't generate the model, but I would assume things like the age, because it's a newer building, looks like a nicer building. Yeah, besides that, I can't really speak to it.
Okay. And then moving on to page 6, those comparable sales, were you able to research them at all? I believe number 4, there was preferential financing involved in that sale. It was built in 2020, so I think interest rates were quite low at that time. Was that considered in that selection?
I'm not too sure about that.
Okay, and then for number 3, I don't believe it's operating as a traditional apartment now, and I think the purchaser also bought the neighboring property. Was it possible that this was a motivated sale that maybe the purchaser paid a above average price for it?
I can't speculate on that. I'm not too sure.
Okay. And then sale number 2, just for the purposes of the subject property, I think that's a concrete building and the subject is a wood frame. Is that right?
Again, I'm not 100% sure about that.
Okay. Believe that is all my questions.
Thank you. Mr. Fletcher, have you any questions?
Not at this time, Mr. Chair.
Ms. Pennard?
Nothing for me, thank you.
I do have a couple of questions, Mr. Deitchen. First of all, with respect to the adjusted NOI that you made in your verbal recommendation, what was the and you did allude to the adjustment of the average rents. I haven't tried to do the reverse math. I'm hoping that you have the math there.
Oh,
What rental rate have you used on that, or is that just a way to? Sorry, did you use an adjusted rental rate for the new net operating income?
yeah, I could figure it out for you real quick. I don't have my sheet in front of me here. Just give me 1 second.
Okay.
Uh, so if my math is correct, it's 1539 92.
Okay. And the other parameters stayed the same with respect to the vacancy at 1.6% and the expense rate? The expense rate of 35.52%, is that model driven or is that
Yeah,
okay.
that's correct.
And on page 6, with respect to the Winnipeg multifamily top sale transactions,
Mhm.
were cap rates calculated on those, or were those buildings sold prior to occupancy? Would you-
Yeah, I'm not too sure about that one. That's a good
Okay.
question, actually. Yeah.
Okay. I had one other that I was curious about. Yes, on your page 5, the gross floor area per unit is 800 for Barnes. The
Mhm.
subject property is 878 square feet, which is the smallest of the gross floor area per unit of the comparables as well. Is that something that is reflective of the ratio of 1-bedroom units to 2-bedroom units, or is there something else at play there that would reduce the gross floor area per unit? Like, are all of the suites just smaller?
Yeah, that could be just because there are more 1 bedrooms. Also, um, common areas is factored into it. So depending on how much this one has compared to some of the other ones, that would impact it as well.
Okay, thank you very much. Those are my questions. Mr. Capus, your evidence, please.
Thank you, Mr. Chair. As the most of the standard property information has been read in already, I'll just move to the bottom of my page 2 there. We are requesting a 2027 assessment amount of $15,768,000. Moving along to page 4, I was able to complete an inspection of this property on August 14th. And then moving along to page 6, there's a couple overhead maps, and then page 7, some exterior photos of the property. On page 8, we have a quick description. The subject property is located on the west side of Barnes Street between Bison Drive to the north and Lee Boulevard to the south. It's a 5-story apartment block built in 2023. There are 19 outdoor parking stalls and 49 indoor. Now moving along to page 13, our income approach description here. So for the purposes of this report, we are disputing the assessor's potential market gross rents of $1,457,000 or $1,786 per suite per month. Now, I believe we just kind of calculated that that's actually 1,539 with that recommendation per month. We are applying a potential market gross rent of $1,149,363 or $1,409 per suite per month, and this is based on the actual stabilized income of the subject property. We have applied a market vacancy allowance of 2%. While the year-end 2024 CMHC average vacancy rates across the city were generally quite low, we don't view these rates as sustainable over the longer term. So I believe the CMHC average was 1.7% for 2024. We've increased that slightly to 2% we view as a floor. And, given the age and location of this property, we've kept it at that 2% floor. For expense allowance, for the purpose of this report, we are applying an expense allowance of $445,232 or 36.1% of effective gross income, and this is based on an actual stabilized expenses of the subject property. Moving along to page 14, we have our capitalization rate analysis, and at this time, if that's okay, I would like to introduce our cap rate study.
Please.
And if we can just carry that through to the rest of the properties as well.
Yes, we can apply the evidence and the questions asked and answered to the other properties. And should I forget to mention it when we're doing when we're hearing the evidence of the other properties, please remind me. Thank you.
Okay. All right, I'll try to keep this brief. Just on page 2, a couple definitions to highlight. The capitalization rate represents the required or acceptable rate of return on a real estate investment. And near the bottom there, the cap rate is influenced by 3 major items: the perceived risk associated with the investment's income capacity, investor expectations for appreciation, and the required returns in other investment vehicles such as stocks and bonds, etc. Moving along to page 4, just wanted to highlight at the top here, section 3.3 of the appraisal real estate 3rd Canadian edition. The basis of income produced in real estate is the future income it will produce. Historical data on a property or a market is relevant only insofar as it helps interpret current market anticipations. And then the second item there, the principle of anticipation is fundamental to this approach. Moving along to page 6. This is just a bit of a summary of the city and other market reports done by other large firms in the city. The city's cap rate ranges are from 3.5% to 8.35%, excuse me, with most being between 5% and 6.2% for apartments. Yeah. And then the broker reports, it should be noted that the ranges in these may be skewed by the inclusion of more investment style properties and may include other costs such as land transfer tax and other closing costs. Every firm is going to maybe stabilize slightly differently, but we mostly rely on these to look at overall trends. And as you can see, it's pretty consistent that it's been flat cycle over cycle. Collier's showing a slight increase for low rise, and they're also showing a slight decrease on the high rise range, upper end of that range. Page 7. Just quickly on a national level, national real estate investment was significantly down in Q4 2024 from Q4 2022 due to economic uncertainties, including but not limited to elevated interest rates, high construction costs, a skilled labor shortage, and a persistent bid-ask gap between buyers and sellers. Then moving along to page 10, this is, I think, something we'll try to reference throughout all the properties today. As of the reference date, April 1st, 2025, there was a lot of uncertainty coming into the apartment sector, and I think it's important to highlight that and give that consideration as we're choosing our cap rates. So that there was increase in operating expenses that were known at the time. The Winnipeg City Council approved an increase in the sewer volume rate on March 27th, 2025, effective April 1st, 2025. This was an increase of approximately 27% up to $4.4 per cubic meters. And council also approved a new waste management fee effective April 1st, 2025. For multifamily properties, the fee was $127 per suite annually. And then additionally, other costs going up are the removal of the education property tax rebate. I will note we have this here just to highlight all the items that were happening around this time, but we have accounted for this in our stabilization, so it's not impacting our cap rate selection at all. But essentially, it's resulted in an increase in total property tax expenses of approximately 25% as opposed to the last few years. And then looking at vacancy and rental demand, as mentioned earlier, CMHC reported overall vacancy of 1.7% in 2024. And this is materially below the approximate 3% level that's often referenced in the industry. And we have a quote there from RBC. And it should be noted that the outlook for rental demand changed before the reference date. On October 24th, 2024, the federal government reduced its permanent resident targets from approximately 500,000 annually to 395,000 in 2025, 380,000 in 2026, and 365,000 in 2027. And then there's also targets for 5% of Canada's population by the end of 2026 for temporary residents. The federal government projected reductions of approximately 445,000 temporary residents in 2025 and 445,000 in 2026, which projected for a national population decline of 0.2% in each year. These newer immigrants and temporary residents are, mostly renters, so this is a big impact on apartments. And at the same time as demand was going down and population was decreasing, there was a huge increase in supply coming online as a lot of property was being built at this time. CMHC forecasts, CMHC reported 3,943 multiple housing unit housing starts in 2022, over 4,000 in 2023, and just under 4,000 in 2024. And they were projecting in that range of 4,000 for 2025 as well. And just below that, you could see the chart showing vacancy dropping, but supply is then now starting to catch up, and we expect that to now push vacancy back up again. And then in terms of regulatory and financing environment, on May 23rd, 2024, the province introduced Bill 26, which proposed limiting the circumstances in which landlords could apply for rent increases above the annual guideline and permitting approved increases to be phased in over several years. Although the bill did not become law during that legislative session, its introduction indicated that the province was considering further restrictions on the timing and extent to which rising taxes, utilities, and capital costs might be recovered through regulated rents. And there was also some changes to CMHC financing, which many of these new buildings, or almost all of these new buildings that are being built are taking advantage of. A little more stricter guidelines for that financing. So I think in conclusion, I think it's important to take all these factors and look at them, and they all kind of compound on one another. Costs are increasing at the same time that new supply is increasing and demand growth is expected to slow. This creates more competition for tenants, more incentives and discounts, and a greater flight to quality. Older buildings have traditionally been able to compete on price, but that becomes more difficult when costs are rising and rent increases may be limited or are limited by RTB guidelines unless and above the guideline increase is approved. And when there's uncertainty about where that is going in the future, that makes it more difficult for owners to make that investment. Newer developments were also underwritten in a much stronger rent growth and population growth environment. The result is greater uncertainty around future NOI, which is directly relevant to the capitalization rate. So I think that's important to think about as we're working through these different properties today. And then on page 13, we just reference some of our typical adjustments. Page 14 We have 4 sales that we've worked up for cap rates and done our own stabilization. Now, these are just samples of the market and they're not direct comparables to any one property, but they do help provide some guidelines. And then we have workups for each one that follow. And then on page 29 is our cap rate ranges for the cycle. And then following is an appendix supporting data for all the above. So if it's okay, I'll move back to the main evidence now for 54 Barnes.
Please.
Okay. So for the purposes of this report, we are disputing, I'm on page 14, sorry. For the purpose of this report, we are disputing the assessor's capitalization rate of 4.8%. Ryan is using a capitalization of 5% based on the capitalization study that we just discussed. So just some factors for this property. It is built in 2023, so our base cap rate for that range is 5%. It does have some good amenities, balconies, a common terrace, gym, and a dog wash station. Parking, it is 1-to-1. Majority are covered and heated. During my inspection, I spoke to the building manager, and they mentioned the heated parking is not has not taken up very well. People are parking at the nearby church or just parking in the outdoor lot instead. They don't want to pay the higher costs for the underground parking. Suite mix, as we've mentioned, it's tilted more to 1-beds, 41 bedroom units, 28 2-bedroom units. The suite sizes, 645 square feet for 1-bedrooms, in the range between 916 and 972 square feet for the 2-beds. And then, as mentioned, in terms of external factors, everything we discussed in the cap rate study there. But on the plus side, it is close to U of M. So, lots of student population. They're going to want to be at this property. However, there's going to be less student visas in the short to medium term. So overall, we felt a 5% capitalization rate is appropriate. Following on page 16 and 17 is the actuals and our stabilized, and then the R&M stabilization as well. And then I'll just conclude on page 18 that we are requesting the 2027 assessment be reduced to 15,768,000. And then the appendix follows with the pictures from my inspection, as well as the city uploaded files and I&E reports. Thank you.
Thank you, Mr. Deitchen. Have you some questions?
Just a few questions. Looking at your page 14, the cap rate information. You start with a base of a 5% cap rate. Are there ever any caps that go below this 5%?
In theory, I think we say that's for a good location property. So if it's a exceptional location and an exceptional property, and there's no other limiting factors, then we could certainly go below that, I suppose. I think in this cycle, with all the external factors I kind of went through, it would be tough to justify going below our typical range, I think, but there may be properties that would justify that.
Okay. Then I guess my next question is, looking on your page 16, your income breakdown here.
Okay.
You say geez, sorry, it's hard to read this. You exclude the 2024 tax rebate. Is this typical practice?
I think so. It was known that wasn't happening going forward. It's a separate line item on the tax bill. I believe there's the calculated, full tax amount less a rebate amount. So knowing that rebate wasn't going to happen in 2025, I think an educated and knowledgeable investor would make that adjustment as well, and they would not consider a rebate going forward if they were purchasing in the market at this time.
But correct me if I'm not wrong here, wouldn't that not be post-reference information if we're looking at the 2025 information?
I believe, I think we noted in the cap rate study at least that it was announced, should have the date here. One second, on page 10 of the cap rate study, the province announced the change in budget 2024 delivered on April 2nd, 2024, and provided further details in an official news release dated April 12th, 2024.
Okay, but I guess ultimately what I'm trying to get at, this seems like kind of speculation. Then wouldn't it be fair to speculate that the income would be higher as well? Because I don't think any owner would just take a hit. They might get rid of rebates or something like that. Would that be fair to say?
Well, we haven't speculated on what 2025 taxes are. We're using the 2024 tax amount. We've calculated the 2024 tax amount. We've just deducted the rebate from that. So it's using the 2024 values. We're not using future tax amounts.
But correct me if I'm wrong again. It says on your mailer that they paid $132,000 in taxes for 2024, and that's what we're stabilizing right here. We're not speculating what it could be in the future.
But what part of speculating, if the rebate has been announced that it's being removed, I don't think that's speculation to not include it in a. If a purchaser is spending $20 million or $15 million on a property, they would consider that.
Okay, I guess just my last question. So in 2024 they paid $132,000 in realty taxes, correct?
Well, I guess, sorry, I have 185 there, but that might be, I think, back pay for 2023. Do you have the actual? Or
Well,
are you saying
you have it on yours. Sorry, I'm just gonna try to flip this around here. On your page 39.
Oh, okay.
Yeah, line 5046, 132,916. That's what they paid. Correct?
Yeah. Oh, yeah, I see. Yeah.
Okay, that's all my questions. Thanks.
Thank you. Ms. Penner, have you any questions?
Just one. Sorry, just getting back to the page on your page 16. In terms of the vacancy, we see the vacancy decrease quite substantially between 2023 and 2024. Obviously, it's a newer building, so that just getting to full occupancy, and is the building as of the effective date or the reference date fully occupied?
Yeah, I think as of 2020, at the end of 2024 reporting, there was, I think, zero occupancy. It was full occupancy. There was zero vacancy at the end of 2024. There had been a tiny bit of vacancy at some point in 2024, a very small amount. And I think generally into, the first part of 2025, it was pretty full. It was quite full as well. So
That's all for me. Thank you.
Thank you. Mr. Fletcher.
No questions at this time, Mr. Chair.
If we could turn first, please, Mr. Kapos, to your cap rate study.
sure.
And there's a note here about page 6. So get to that, please. Yes, these are the market reports that the capitalization reports that have been reported by Colliers, CBRE, Cushman, etc.
Yeah.
First of all, the apartment type to which we're referring here, would that be classified as a low-rise A or a low-rise B?
It's a newer property, good location. I think it would be an A.
Okay, so the low-rise A and the published market reports, those would include the theoretical and anticipatory costs to which you referred as well, would they not? As the Ryan one does?
Potentially.
Okay.
I think that they partly calculate those on sales that they're aware of, but I would presume that they would try to factor in some of that as well, yes.
Okay, so,
However, sorry, I will just note that their reports are sort of one quarter behind always, right? So their 2025 Q1 is based on Q4 of 2024. So they always need they're always one quarter behind essentially on what the data they're reporting on is. So some of the stuff, the announced utility costs probably would not have been reflected in these in the Q1 cap rate studies because those were very late in Q1 of 2025.
okay, but you don't know that for sure.
I do not know with absolute certainty, no.
Okay, I'm just looking at the ranges here. CBRE low rise A is a 4.5 to 5.25. CBR or the high rise, sorry, I'm just looking at the low rise A. Cushman is a 5 to a 5.75.
Mhm.
The ranges are either 75 basis points or roughly around 75 basis points from low to high for the low rise A. That's fair to say?
Low rise A, I guess CBRE is the only one that breaks it out between A and B for low rise, but
Right.
so for their A, yes, yeah, 75 basis points.
Okay, but Ryan's range is only 50 basis points. 5 to 5.5. Is that correct?
Yes.
Okay. Now, other than the examples of sales that cap rates were stabilized and factored in, and those are the ones found at page 14. There's no other empirical studies that form part of the cap rate study with respect to mathematical calculations of cap rate. Is that fair to say?
Yes.
Okay. And none of these rather, I was going to say subject properties. None of these cap rate properties, 300 Furby, 160 Lumsden, 345 Talbot, or 677 Maryland, would be in either an age or location or even category as the subject property. Is that fair to say?
Yes.
Okay. Thank you. I don't have anything further. Mr. Deitch, any summary required?
No, thank you.
Okay. Mr. Capus, summary?
No, thank you.
Thank you. Then, having heard the evidence, we will conclude this matter. And we will move to number 3 on the docket. And there is a preliminary issue with respect to the evidence to be called at both 3, 4, 6, and 7. And that is a late evidence notification. I can tell you, Mr. Capus, that the panel has not received a copy of your evidence, assuming it was filed, because it was designated as late. So to deal with the late evidence aspect for the remaining properties, excuse me, I propose to deal with them all at once because I'm assuming the issues are the same. But first of all, we don't have that evidence. It's being classified as late evidence. Can you tell us, please, when that, or perhaps Mr. Villanova can you tell us when that evidence was received?
Yes. Sorry, I didn't realize it doesn't get sent to you at all if that happens. I think it was 1 minute late. I think I have the email here showing 4:31 sent for the second part of my submission. I left, I did a lot of inspections for this docket and I left attaching the pictures late and they were some big files. So ultimately it rests on me. I should have given myself more time, but it was, I think, only 1 minute late. And that was probably partly due to the size of the files being sent.
And is that for all of the properties? I'm looking at Ancaster Gate, Pembina Highway, De La Cathedral, and St. Anne's? They're all
Yes.
one lake?
I believe so.
Thank you. Those are my questions with respect to that. Mr. Villanova, can we go in camera, please, and we can discuss how best to proceed?
Of course.
Thank you. I'd like to call the meeting back to order. The panel has considered the issue of late evidence, and we are going to allow the evidence to be before us. So, Mr. Lanova, if you can please forward the applicant's evidence to us for the 4 properties remaining.
Mr. Chair, I will.
And
distribute.
once that's been distributed, do we have to refresh?
Yes, I think it might be such and I will add it to the SharePoint.
Okay. Let me know when that's added.
It should be good to go for yours,
Okay.
and it should be added onto the SharePoint as well.
Okay, Ms. Penner, if you can let us know when you've received it, please.
I've received everything. Yep, it's all there now.
Great, and Mr. Deitchen, I'm assuming that you have had a chance to see it, or you have a copy of it now as well?
Yep.
Okay, great. Then I would ask that we turn to number 3 on the list, the street address of 25 Ancaster Gate. Mr. Deitchen, if you could please introduce the property and provide us your evidence.
So it's file 263998. Roll number 0309156760 25 Ancaster Gate. Assessed values at $18,794,000. Again, I have a recommendation here using an NOI of $855,916 with a cap rate of 4.75%, bringing the value to $18,019,000.
Sorry, that cap rate again was
4.75.
4.75.
No.
Sorry, one moment, please.
You just got to repeat the and the roll number again. Sorry.
Oh, okay, Mr. Deitchen, could you repeat the file number and
Sure.
the roll number, please?
Yeah, so it's file 26-3998. Roll number is 0309156760 25 Ancaster Gate.
Thank you, and with that recommendation, Mr. Capust, were you aware of this recommendation, or have you considered this recommendation?
Yes, and I would like to continue with the hearing as well for this one.
Thank you. Then, Mr. Deitchen, would you please continue with your evidence on this address?
Yeah, so this is a 2019 build with 69 units. You could scroll to page 3, just map view of the property with an exterior shot. Page 4, again, is the income value summary. So there are 16 1-bedrooms, 53 2-bedrooms, at an average monthly rent of $1710.66. The model NOI is $892,705 with a cap of 4.75%, brought the value to $18,794,000. On page 5 is my rent comparables again. Again, trying to find similar year builds in the area where the subject is with similar suite mixes. You could see that the average monthly rent again ranges from $1,755 to $2,109. So the subject falls actually below that range. On page 6 is the sales table. You can see that the subject is at $272,000 per unit and $265 per square foot. You could see again that falls in the range of the 4 comparables. Again, on page 7 is just our cap rate table. Page 8 is the Municipal Assessment Act. Page 9 to page 16 are the income and expense mailers. You can see page 17 and 18 are the permits for the building. And then page 19 and forward are just some pictures and some information on the building. And that is my evidence. Thank you.
Thank you, and I did neglect to say at the outset, but the questions and answers that were provided and the evidence that was provided with respect to the capitalization rate study to which we referred and to which the applicant made presentations in property one will carry forward to this property as well. Okay, thank you. Mr. Capus, have you any questions for Mr. Deitchen?
Yes, just a few, please. If we can look at page 4. For the year expense rate of 35.95%, was any consideration given to adjusting this upward to account for the property? All utilities are included in the rents of this property, so all utility costs are borne by the landlord. Do you think that expense rate is maybe a bit low for a building like that? And should it have been adjusted upward?
I did adjust it upward for the verbal recommendation. I
Okay.
believe. Yeah.
Okay. And then again, I guess for the cap rates, I asked this last time, but what about the model what about this building would drive the model to go outside your typical range for this property?
Again, I can't really speak to it too much, but newer building locations such would be factors into it, but I can't speak specifically to it.
Okay. And in general for the model, does it account for kind of external factors such as changes in immigration guidelines and increases to costs and stuff like that, or do you know?
I'm not too sure about that.
Okay. And then moving along to page 6, those sales again, just to note, I think that first one on the top left, that picture, Lumen at South Point, it is more of a townhome style apartment. Would you say that is a good comparison to more of an apartment style like the subject?
Sorry, can you repeat the question?
Sorry, the picture in the top left, Lumen at South Point, looks more of a townhome style property, and the subject is an apartment style. So slightly different metrics, I think, for those types of properties. And
yeah. I mean, it's not on our table, but yeah, it's up there.
Yeah, okay.
But yeah, no, I agree. Yeah.
Okay. And then, yeah, I guess. So, and for these sales below, you're not sure if any of them had preferential financing, they were motivated sales or anything like that?
No, I'm not aware of that.
Okay. That is all my questions for this property.
Thank you. Ms. Penner, have you questions?
Just looking for a bit of clarity around the recommendation. So you said the recommendation was based on increasing the expense ratio. Is that correct?
That's one of the factors. It was using the actuals for the property.
Okay. So a slightly lower rental rate and a higher expense ratio?
That's correct.
Expense rate? Okay. That's all for me. Thank you.
Thank you. Mr. Fletcher, questions?
My questions have been asked and answered, Mr. Chair.
And I don't have any questions either. So Mr. Capus, if you can please allow us to open up your file, and if you can provide your evidence with respect to 25 Ancaster Gate.
Thank you, Mr. Chair, and thank you to the panel again for allowing the evidence in. We move along to page 2. We are requesting an 2027 amount of $16,387,000. Just to note, after this report was put together and submitted, I did inspect this building on August 18th. So it was good to just see it in person and go through the property. Page 6, just a couple overhead maps, and then page 7 is an exterior photo of the property. Page 8 is a description of the building, which the assessor, I think, has covered well. Just note there are 93 outdoor parking stalls. Moving along to page 13, the income approach. For the purposes of this report, we are applying a potential market gross rent of $1,375,200 or $1,661 per suite per month based on the actual stabilized income of the subject property. For vacancy allowance, we've set it at 2%, which is our kind of guideline floor for this cycle for properties. And then for an expense allowance, we're disputing the assessor's original rate of $501,058 or 36% of effective gross income. And we've applied an amount of $608,316 or 42.6% of effective gross income. This is based on the actual stabilized expenses of the subject property. And I think it should be noted here again that, that this property pays all the utilities themselves, and then it's included in the rents for the tenants. So then moving on to page 14, the capitalization rate, so that we are disputing the assessor's rate of 4.75%. We are using a rate of 5% based on the capitalization rate shown, based on the study we've already introduced. For a building of this age, 2019, our base cap rate starts at 5%. This is a wood frame building with balconies. It's in good condition. Good parking ratio, though it's all outdoor. It's, I think, 135% parking stalls to units. And then just again, all the rising costs and other factors that we've discussed in the cap rate study, kind of painting a not so rosy picture for apartment investing at the reference date. So despite all that, we've still went to the low end of our range at 5%, given all the good factors for this property. So we deem that to be reasonable. And then page 15, we calculated the market value of $60,387,000. Page 16 and 17 are our stabilization tables for the overall operations, and then a little more granular R&M stabilization. So to conclude on page 18, we are requesting the reduction to the 2027 realty assessment for the property to $16,387,000. And then an appendix follows with some marketing materials and the documents that were submitted to the city. And that is my presentation.
Thank you. Mr. Deitchen, questions?
I guess just my questions regarding the tax, property taxes paid carryover from the last one, but can you confirm on page 25 the actual taxes they paid is $124,000 for 2024?
Assuming that's correct, I'll just $124,000 is what was paid net of any rebates. Yes.
So that's what they paid. Okay. And then I guess my second question is how come you didn't use the actual vacancy for this property?
And by actual, I guess you're saying for 2024, the 0.3.
Correct.
Again, I think that was almost zero, and I don't think that would be typical of an investor to apply such a low vacancy. But there is, I think I think that would be too low. I think as we've said in the cap rate study, their kind of guidance for a healthy market is 3% vacancy. We've applied a 2%, which I think is more than fair. So
how did you come to the 2% though? Was there a calculation done or?
No, again, I think it's a mixture of, a healthy market is 3%, acknowledging that at 2020 end of 2024 CMHC, which I think their reporting actually ends in October of 2024, was an average for the city of 1.7%. This is a newer building in a good location. So we kind of, found a middle ground. We don't see any reason to adjust above our kind of 2% floor that we've established that a typical investor might apply in their underwriting of a purchase. So we've kept it at 2%. And yeah.
I guess just one more question. You mentioned that this is a newer building in a good location. So I guess my question again about your cap rates, would this one not maybe warrant a lower cap rate than your base?
As I said, it's that range is we say it's for a good location. This is a good location. It's a wood frame building that compared to a concrete building that already knocks off, I think if you look at cost guides, it's probably 5 years of a estimated economic life of a building. So given all the broader market uncertainty, rising costs, moderating demand, increased supply, we don't see any reason to go below our indicated range for this property.
That's all my questions. Thanks.
Thank you. Mr. Fletcher, have you any questions?
My questions have been asked and answered, Mr. Chair. Thank you.
Ms. Penner? Questions?
Just sort of on the topic that was just being covered in the last question, is there a building that would go below that 5%, or would you call that sort of your base level for cap rates in the multifamily market at this time?
I guess there's a lot of, I guess, or if we're just talking a newer stabilized property with no, there's certainly a possibility of that. I'm sure there's some sales that have, traded in the, a few years back, even below 5, but I think it would be very few properties as of the reference date of April 2025 that would go below 5, but there are some very good quality properties that if they were to go to the market, they might, but those properties also don't go to market a lot. The developers build these, and to get their return, they need to typically hold it for some time, as there's not a lot of buyers for those types of buildings anyways.
For me, thank you.
My question is with respect to the, sorry, I'm looking at page 16, and this is following up on the questions that Mr. Deitchen was asking. And you have the actuals, or you've reported some of the actuals with respect to potential gross rents, and those are divided up in your income statement later on, including discounts or with reduction discounts. Those are the actuals, but in some cases, for example, with respect to the vacancy, you have used either market vacancy or non-actuals for the income statement. Have I got that right?
Sorry, for the vacancy, yes, we've applied an average 2%, which is, and what was the other part, the other item you were asking about?
Well, what are some of the other market rates instead of the actuals that you've used? Thinking about the expenses.
Right. So management fee, we apply a standard rate of 5%. So that ends up a bit lower than 2023 and 2024 for the subject property. For the most part, we've averaged everything else.
Okay.
And then 2024, of course, as I've mentioned, we've removed the rebate, and then R&M on the next page, we've tried our best to remove kind of one-time items that we know aren't going to be recurring and stabilize in that respect.
Okay, thank you. I don't have anything else. Mr. Deitchen, any summary?
No, thank you.
Mr. Capos, any summary?
I'll just say on those expenses, I think it would be expected that we do, when we're stabilizing the R&M, that we do remove one-time items that we know aren't recurring going forward. And I think we followed that same, structure for the property taxes where we removed the rebate, which we know is not going to be recurring going forward. So, thank you.
Thank you. Then, having heard the evidence, we will conclude this matter and we will proceed to number 4 on the list. That is the street address of 1125 Pembina Highway. And as was the case for the previous property, the questions and answers and submissions that were made with respect to the Ryan cap rate study that was provided will carry over on to this property as well. So, Mr. Deitch, and then if you could please introduce this property and provide your evidence.
So this is file number 26-4050, roll number 030930100305. The address is 1125 Pembina Highway. Assessment value is at $23,003,000. The actual year built is 2024. There's 82 suites in this building. If you continue to page 3, you got the overhead view of the property and the exterior view. Page 4 shows that there is 53 one-bedrooms, 29 two-bedrooms for 82 suites at a total of $1,689.56 per unit. The model NOI is at $1,058,118. The cap rate is 4.6%, and that brought the value to $23,003,000. Page 5 is the rent comparables again. Again, tried to find comparables in the area, similar suite mixes, year built. You could see that the range again is 1755 to 2109. And the subject falls well below that range. You could see on page 6 again is the comparable sales. So the subject is at 280,000 per unit and 228 per square foot. Again, that falls in the range for per unit rate. Page 7 is the cap rate table. Page 7 or 8 is the Municipal Assessment Act, and then page 9 and forward are just some information regarding the subject property. You can see that it's modern, sustainable luxury apartment complex. The amenities on page 10 and 11, 12. And then on page 13 and forward are the pictures of the subject property. And with it being a new building, we didn't have any mailers to use or go off of for this property. And that is my evidence. Thank you.
Thank you. Mr. Capus, questions?
Yes, please. Just a couple. Excuse me. On page 4, for your market rents, was there any consideration given to use what's, I guess you said you don't have the mailers, so that's
correct. We didn't get any 24 mailers because I guess it was built in 24. Yeah.
Yeah, I think that's okay. So you've just, okay. I will leave that then. For the expenses of 35.32%, do you think that's low for a building with underground parking and balconies, even though it is quite a new building?
I would say that's right in the range for a new building. Yeah, I can't speak to the underground parking aspect of it.
Okay. Then just again, this is a very low cap rate relative to your guided range, but you're not sure what exactly drove the model. But you do have the ability, if you think you can adjust these manually if you think it's required, the cap rates.
Like if I was doing a recommendation or something, I could, but I feel like this cap rate is fair for this building.
And what makes you think that for the 4.6%? What are the factors?
Just like I've said before, it's a brand new building, great location. You can see the pictures and the information. It looks like they called a luxury apartment. It looks very nice. So yeah, I would say that's fair.
Okay, moving on to page 5. Just in terms of the suite mix, I noticed that I think all the comparables are heavily weighted to 2 bedrooms, and the subject is the opposite, more 1 bedrooms. Could that have influenced the average rents to a higher rate for the comparables?
Yeah, but the subject is lower than all of them, so I think it's fair.
Okay, and did you try to find a property even lower than that just to sort of bracket the comparables and show a full range
Lower in sweet mix?
in rents, just to establish that there, what is something below that?
I don't really follow the question.
I think generally for appraisal, when you're doing a direct comparison like this, you should try to find properties that are above and below, and then bracket the subject property in a way to show that you found something worse or not as good and something better, and you feel it's somewhere in between. So to establish a floor and a ceiling.
These are just all the comparables I could find that fit the parameters.
Okay.
So.
And then did you look at common area spaces for the subject versus these buildings? I think the actual sizes of the units for this property are 2 beds are 900 square feet and 1 beds are almost all 613 square feet. So this gross floor area for the subject you're showing of 1,230 is quite a bit higher than that. Is that potentially influencing anything with the model or how it selected rents?
I can't really speak to that too much.
Okay. Moving on to page 6. I think we've already discussed this, but yeah, you're not aware of any preferential financing or motivated sales here.
No, I'm unaware.
Okay. That is all my questions for this property.
Thank you. Mr. Fletcher, any questions?
I do have one question for the assessor. Mr. Assessor, are there any commercial spaces that are available to your knowledge in this building?
Not to my knowledge, no.
Okay, well, if there were, sir, would you be taking those out of the gross floor area?
I would believe so.
Okay.
Yeah, I don't think this one does have any. But yeah, I'm not too sure. Like we would have had a separate income stream for the commercial area if we did, or if there were. So
Okay, thank you, sir.
yeah.
Thank you. Ms. Penner, have you any questions?
I do. I think it's more out of curiosity than anything. So with this building being so new, as of the reference date, would it have reached full occupancy? And if not, is that factored in at all?
I'm not too sure about the occupancy or the vacancy. Um, we would have just applied the market vacancy for this building. And again, usually these buildings, yeah, the first year they might be at a higher vacancy, but they usually lease up pretty quickly. So we wouldn't have applied a higher vacancy for this building.
Right, that was all for me. Thank you.
Thank you. And I don't have any additional questions with respect to this. Mr. Capus, please, your evidence.
Thank you. I will proceed to page 2. We are requesting a 2027 assessment amount of $19,193,000. Moving on to page 4. I was not able to inspect this building, but my colleague did, I think, as part of the supplemental assessment last cycle. So do have some good pictures of the property. Moving on to page 8. Yeah, the subject property is located on the west side of Pembina Highway at the intersection of Point Road and Windermere Avenue. It is a 6-story wood frame multifamily building. And just wanted to note again, I think, excuse me, mentioned there's 53 one-bedroom units, 29 two-bedroom units. The one beds are, there's 50 of them that are 613 square feet, and then 3 that are 698 square feet. And then for two-bedroom units, there's 29 of them at 907 square feet. Moving along to page 13. For the purposes of this report, we are disputing the assessor's potential market gross rents of $1,662,527 or $1,690 per suite per month. We are applying a potential market gross rent of $1,565,520 or $1,591 per suite per month. That's based on an actual stabilized income from a late 2024 rent roll that we had as part of the supplementary appeal last cycle. We've again applied a 2% vacancy allowance. And for the expense allowance, for the purposes of this report, we are disputing the assessor's expense allowance of $577,809 or 35.3% of effective gross income. We are instead applying a expense allowance of $639,767 or 40% of effective gross income. Stabilized expense ratios typically range from the mid-high 30% to the low mid-40 range for well-operating properties. And given that the property is improved with a new building with indoor parking, elevators, and balconies, the expense ratio for the property should reflect their higher end of the range. So we've applied 40%. Moving along to page 14, excuse me. I do want to note I have a bit of a typo here in my first paragraph. We are disputing the assessor's capitalization rate of 4.6%, not 5.51%, and we are applying a rate of 5%, not 5.52%. Sorry about that typo there. And then just discussing some of the factors that went into this choice for a new building like this, 2024 built. Our base is again 5%. This is a mid-rise wood frame building. It's got a social room, in-suite laundry, elevator, balconies. It's pet friendly. It's in good condition. Parking ratio is pretty good at 0.9 stalls per unit. There's a mix of indoor and surface. In terms of locational factors, it's a high traffic bus route with a rail line behind it. And then as we've discussed in the cap rate study, there's a lot of uncertainty at the reference date regarding investment in the apartment market. So we've, in consideration of all those factors, we have gone with a 5% cap rate, which we deem to be quite reasonable. Page 17, similar to the assessor, we don't have a ton of info to stabilize, so there's not much there for the stabilization. And then page 18, in summary, we are requesting a reduction to the 2027 realty assessment to $19,193,000. And then the appendix follows with photos from that site visit as mentioned, and the some city provided property info and that rent roll that I referenced. And that is my presentation.
Thank you, Mr. Deitch. Any questions?
I guess just my same questions about the cap rate stuff. You kind of mentioned the 40% expenses that you applied. How did you calculate these exactly?
It's just based on, I guess, market knowledge. I think we all know that we deal with a lot of newer properties, and that's within that range for newer property of this with wood frame construction and underground parking and balconies and etc. So that's what we've applied.
Okay, so it's not based on any actual calculations. It's just kind of what you applied up here.
Yeah, there's no specific calculation behind it
Okay.
in reference to this specific property.
Okay. Yeah, no, that was all my questions. Thanks.
Thank you. Ms. Penner, questions?
And no questions for me. Thank you.
Yeah, Mr. Fletcher?
Are you, yes, Mr. Chair, I have a question, for the applicant. Are the utilities included in the rent, sir? In this building?
Um, you know what? I'm actually not sure at this time.
Thank you. That's all the questions I have.
Thank you. My question, Mr. Capus, relates to the very end, like page 46, page 47, where you have reproduced or filed the rent roll for this
Okay.
particular property. And I haven't had time to add it all up. I'm going to trust your math on this, but the difference in effective gross income between your calculations on the actuals and the city's is about $30,000 overall. Is that fair to say?
Um,
I'm looking at your effective gross income.
yeah,
Okay,
because I guess, yeah, I think the city kind of blends everything together. So after we've added an amount for parking, it's about $35,000
right,
difference.
okay. Okay, and that's based on the actuals of rent that's been received or is being hopefully received.
Yeah.
Okay. I was looking for the expenses that would justify the 40%, and I don't see them in your report. With respect to the 40%, and you referenced or you alluded to increased in expenses for underground parking, which is why you had used the 40% expense ratio. Is the 40% expense ratio empirically determined, much as the rent roll actuals have been, or is that an estimate based on potential problems to be discovered later?
More of an estimate.
Okay, thank you. I don't have anything further. Mr. Deitchen, any summary?
No, thank you.
Mr. Capist,
No, thank you.
does anyone need 5 minutes before we proceed to numbers 6 and 7? Scroll it over, or we can keep going, or if you need 5 minutes, or if anyone needs 5 minutes to refresh a coffee. I see we've been going for about an hour and a half. You know what? Let's take 5 minutes. There we go. 5 minutes. If everyone can be back around 10:29, please.
Okay.
Thanks. Thank you. I'd like to call this meeting back to order, and if we can turn to number 6 on the docket, that is the street address of 321 de la Cathédrale. If we can please apply the evidence, the submissions that were made and the questions and answers from the cap rate study that we did earlier, the cap rate study evidence that we heard on behalf of the applicant, apply that to this property as well. And Mr. Deitchen, if you can please introduce the property and provide your evidence.
Okay. So this one is file 26-2385. Roll number 0609322570. Address is 321 Del La Cathedral Avenue. And there is non-compliance information I have submitted for this property.
Right, okay, then what I would ask you to do is after the property has been introduced, go down to the non-compliance and we'll deal with that. So if you can
Okay.
give us evidence in a nutshell and then proceed with the non-compliance aspect. Thank you.
Okay, yeah, so it's on page 15 and forward, is the 2024 non-compliance information. This is the Municipal Assessment Act, so date, mail, sent and received. When under this act, a notice or other document is mailed to a person, it is presumed to be mailed on the date of the notice or document, and it is deemed to be received on the 5th day after the day the notice or document is mailed. And then on page 16, you can see that this is the income and expense mailer cover letter sent on April 8th, 2025 to the owner. And then pages 17 and forward are just the blank income and expense mailers. And that is all. Thank you.
Thank you. Mr. Capus, have you any questions dealing with the non-compliance request?
Questions? No. I believe yeah, I don't have any questions.
Okay. Ms. Penner, any questions on the non-compliance?
No questions for me, thank you.
Mr. Fletcher?
No, sir.
And I don't have any. So Mr. Capus, have you any evidence to provide with respect to the non-compliance?
No, by all accounts, I think it was just missed. I spoke to the client and they did very recently submit it in good faith, but I understand that that's far too late and so
Okay,
there's
thank you. If we can go in camera, please, and we'll discuss it and make a determination. Thank you. I'd like to call this meeting back to order. Mr. Capus and Mr. Deitchen, the panel will be allowing the application for non-cooperation. That has the effect, Mr. Capus, of putting the onus on you, so I would ask that you present first. In addition, the other orders under section 53 and section 54 will follow. So, Mr. Capus, if you could provide your evidence, please, with respect to the address on number 6 on the docket.
okay. Thank you, Mr. Chair. Believe the file number and roll number has been read in, so I will just proceed to the on page 2 near the top. We've got the original and effective age of the property. This is kind of a mixed bag. There's a portion originally built in 1912, and then there's another portion as new as 2007, according to the city in terms of effective age. Excuse me. The property has a gross floor area across these various buildings of 127,272 square feet. There's a portion that's 3 stories and another portion that's 4 stories. The suites are as follows. There's 63 studio apartments, 69 one-bedroom units, and 10 two-bedroom units. The total site area is 102,926 square feet. The 2027 city realty assessment is $21,730,000, and
Sorry,
we're
Mr.
requesting.
Capus, can I just interrupt? I apologize for interrupting, but the live stream is evidently frozen.
Okay.
We have to address that, please.
Okay.
So I'm sorry to interrupt. We'll pick this up as soon as we return. Thank you. I'd like to call the meeting back to order. It appears as though the technical difficulties have been solved. Thank you very much. And Mr. Capus, you were just at the very beginning of your presentation. The files have been read in. I believe you were discussing the site area as well, and you had concluded or you finished with the valuation amount of $16,799,000. If you feel you need to repeat anything, feel free or continue with your presentation.
Okay, thank you, Mr. Chair. I will just move on to. I'm getting an echo.
Yeah, I don't.
Is that better now? Or? Okay, I didn't hear anything now. So.
Okay, good. Well, if there's problems, let us know.
Okay. Sorry about that. Okay, page 2. So we've finished that. I will move on to page 6. Just a couple overhead shots of the property, a map and an overhead shot. And then page 7 is some exterior photos of the property. Excuse me. Okay, now page 8, property and land improvements description. The subject property is located on the north side of De la Cathédrale Avenue between Saint Jean-Baptiste Street and Desmarins Street in the central St. Boniface area of Winnipeg. The property consists of 3 adjoining apartment blocks built in between 1912 and 2007 with an effective age of 2000, presently being used in assisted living, multiple family residential buildings. The site size, according to the City of Winnipeg Property and Taxation Department records, is 2.4 acres. Based on assessor's data, 19,691 square feet were built in 2007, and the rest was in 1912. Subject property has a total of 142 units, including 63 studio units. These are around 268 square feet each, 69 one-bedroom units that are 416 square feet, and 10 two-bedroom units that are 707 square feet. So these are all quite small units. And it should be noted that the subject is a heritage commemorative list structure. The commemorative list recognizes properties for having heritage value and encourages conservation, but does not explicitly restrict demolition or alterations. Then there's some commentary on highest and best use and Manitoba Municipal Act. Moving along to page 13 is our income approach. I guess this gets a bit difficult because we've sort of defaulted to the city parameters, but I will, and those haven't been introduced yet, but I will nonetheless go through that. The subject property operates as an independent living facility with actual revenue materially higher than the assessor's applied market rent due to the specialized nature of the operation and associated services and business components. We have applied, just like the assessor will go through, market gross rents of approximately $1,829,346. However, we have applied this, but the subject's physical configuration, including smaller suite sizes and limited kitchen facilities, together with its more limited tenant market, creates additional leasing marketability and functional risk relative to a typical apartment property. And these factors have therefore been considered in our capitalization rate selection. For vacancy allowance, we've applied as our standard 2%. And for expense allowance, we are applying 41.6% of effective gross income, which works out to $749,813, as the assessor has. However, the subject's actual expenses reflect the independent living operation and include costs associated with services and business components that would typically not be incurred by a conventional market apartment property. So again, we've tried to account for that in our cap rate selection. Moving on to the cap rate selection, we are using a capitalization rate of 6.25%. Which is above 4.85%, which the assessor will be reviewing. Some of the notes we have here factoring into this choice, the age effective year built of 2000 as per the city. The actual structural age ranges from 1912 to 2007. Excuse me. Building type and construction, it's masonry across the three buildings. The heritage status designation, as I've mentioned, it's recognized on the City of Winnipeg commemorative list, which recognizes properties for having heritage values and encourages conservation. Does not explicitly restrict demolition or alterations. However, there is risk of potential community resistance to any sort of alterations. The parking ratio is quite low at this property, and the suite mix is quite poor as well relative to the market, with many studio units. And the suite sizes are very small. Again, the studio or bachelor units are 268 square feet. The one bedrooms are 416 square feet. And the two bedrooms are 707 square feet. So along with all these factors, factoring in all of the upcoming kind of uncertainty discussed in the cap rate study, we've gone with an overall capitalization rate of 6.25%. I think it also is important to highlight from that cap rate study that that per unit waste management fee, I think it was $127 per unit. Confirm that. Yes, that was announced in Q1 of 2024, is particularly negatively impactful for properties where the unit mix is weighted to small, lower unit costs like the subject. Just on a proportional basis, it is a higher impact and there is less room to increase rents and absorb rents. Whereas if it's a building with a lot of two-bedroom units where rents are a bit higher, might be able to absorb that a little better. So then on page 15, our market value based on these parameters is 16,799,000 rounded. Page 16 are 22 and 2023 actuals. I apologize, some of the average column appears to have didn't copy over properly when I pasted it into the report here. But you can see our overall stabilized numbers and what we've done there. And then moving along to page 17, we are requesting an assessed value for 2027 of 16,799,000. And then in the appendix to follow are just some city provided property data and the I&E statements that were available, along with the document regarding the heritage and some information on the seniors housing component of this property. That is my presentation.
Thank you, Mr. Deitchen. Any questions?
I guess, well, our NOIs are pretty close. So I guess my questions are just based around the cap rate. So I guess my question is, the base cap rates, I guess, are 5, and then it kind of starts from there. Is there actual like calculation how you get to 6.25? Like, is there a percentage allocated to age and other things like that, or is it based on something else?
There's no specific calculation in terms of
Okay.
which each factor was X amount percent or whatever.
Oh, okay. And then my second question, the fact that there's a large portion that was built in 2007, so newer, was that factored into the cap rate calculation or determination?
To some extent, but I mean, I think there's a lot of overriding factors in terms of the small suite sizes and just the suite mix and the fact that I think a larger portion is a majority of the property is older. So
I was going to ask that question. Do you know, like, because I thought like almost 80,000 square feet was the 2007 building.
maybe
I'm
we
not-
miss. Yeah.
Like, I thought it was the two like wings on the right side of your picture there on page 6. I could be wrong again, but that was my impression.
I think we had based it off the page 20, which is the city provided commercial section details, but maybe we misinterpreted or miscalculated one of those figures.
Oh, okay.
I think, yeah, so.
Okay, yeah. Oh, so 19,000 probably, and 4 stories times 4 would be about 80,000. Okay, I think that's where I got that 80,000 from.
Okay, maybe we misinterpreted.
Like, you're building
that
3 on
as-
page 20 there. It says 19,000, 4 stories, so about 80,000.
Oh, so it's
And-
so that's per story. Yeah.
I think
That
so. Yeah, I believe so.
Okay, then well, it's possible that I think on page 8, where we say the 15.5% of the building was built in 2007, that it's possible that's wrong if we misinterpreted how the city breaks that down there. But
Okay, no other questions, thanks.
Thank you. Ms. Penner, questions?
No questions for me right now, thank you.
Mr. Fletcher?
My questions have been asked and answered. Thank you.
I have questions, Mr. Capus, with respect to the cap rate determination on page 14, where you've selected the 6.25.
okay,
Your location and external factors. This property is being used as a senior and assisted living. Is that correct?
yep.
Okay. The location and external factors, that risk in market rental rate, operating expense ratio, broader market uncertainty, including moderating demand and increased supply. Would you agree that that's more applicable to general rentals as opposed to senior-based rentals? Or is that with respect to senior-based rentals as well?
No, I agree that there's probably some impact on the senior rental, but that would more be applicable to traditional rentals. And I believe, yeah, with the maybe I should have explained it better since I did know that it would the burden of proof would switch to me. But I believe we've kind of we've valued this property as best we can as a standard apartment, and then adjusted the cap rate to account for all these factors. You know, the rents are way above what you could I believe, what you could actually rent these units for in the market as a standard apartment. So we've tried to account for those limiting factors in the capitalization rate, but the expense ratios and market rental rates are generally in line with market parameters. And I believe that's kind of the guidance that over time the city has developed for these types of properties. We're not using the in-place income and expenses because it's a very specialized type of building. So we try to apply market rates and standards.
Right, with the specialized building, you're trying to fit a not necessarily unique use, but a different use cap rate into the traditional rental cap rates. Is that fair to say?
I think so, yes.
In your cap rate study, use of the building is not one that figures prominently. Is that correct?
Like, are you
Well, I'm looking at
page 14 or the cap rate study document? Sorry.
The cap rate study generally, the cap rate study document generally, they talk about strength of covenant being important to cap rate determination or investor interest, but that is not necessarily the case here because this is a non-traditional use. Is that fair to say?
Yeah, and I think on similar properties to this, we do typically note on page 14 there that we make an adjustment for, you know, the special use of the property, but I did not note that here. So.
And special use could result in a decrease of the cap rate as opposed to necessarily an increase, could it not?
Theoretically, if that use was less risky and more profitable than a standard use, then yeah.
Okay, thank you. That I think we're delving more into speculation. My apologies for that, but I don't have anything else. Mr. Deitchen, your evidence, please.
Okay, I actually do have a recommendation for value on this property. So it would be using our NOI and adjusting the cap rate to 5.25%, bringing the value to $20,075,000. Sorry.
20,075.
Yeah.
On a 5.25 cap rate and the same NOI.
That's correct.
Okay. And Mr. Capus, I don't know if you were aware of that recommendation, but did you wish Mr. Deitchen to proceed with the presentation and have the determination made, or would you are you prepared to accept the recommendation?
I'd like to proceed with the presentation.
Okay, thank you. Mr. Deitchen then.
Okay, so page 3 again is just some pictures of the property. Page 4 is the income value summary. There's 142 units at an average monthly rent of $1,073.56. NOI being $1,053,922, and the cap rate 4.85%, which I adjusted. But the value for the model is $21,730,000. Page 5 is the rent comparables. Again, try to find similar buildings, suite mixes and age, year built. You can see that the range is about 1,008 to 1,337 a unit, and the subject property falls in that range. Then on page 6 and 7 is just our CMHC market rents. Because this property is a seniors living, we can't use the income and expenses. So you can see I did a table for the suite mixes on the bottom of page 6, and then I did year built on page 7, and then it brought us to a yearly potential rent of 1,970,369, which is and the model is 1,829,346, and the percentage is 92.8%, so about 8%, 7% lower than the monthly. Page 8 again is our cap rate table. Page 9 is the Municipal Assessment Act. I did include the older mailers, but again, they aren't very helpful for our purposes right now. Page 12 is just some information of the property, and 13 and 14 as well as just some amenities. And that's my evidence. Thank you.
Thank you. Mr. Capus, questions?
Thank you, Mr. Chair. We could go to, I do have a couple questions. Page 4. On your expense ratio of 41.57 for a mixed building with various ages, do you think that 41.57 is appropriate? Like some of the sections of this building are over 100 years old.
I think it's appropriate. I think it's been renovated as well, so I think it's a fair expense ratio.
Okay. And then on the cap rates, I guess I think you adjusted up to 5.25, but here it's 4.85. So either way, it's either below your 60th or the 20th percentile or low end of the range there, or just above it. I guess you can't answer what the model was thinking, but do you think that's reasonable for a building of this age? There's a mix, as we said, there's a portion that's maybe it's renovated, but is over 100 years old. The units are very small. Do you think there's any additional risk there to maybe, what can explain that lower cap rate?
I mean, I can't really explain it. I did adjust it up, and that's where I feel like it is fair.
Okay, and then just pages 5 through 7, some of the rent analysis.
Mhm.
Most of the comparables don't have bachelor suites, and yes, so it was consideration given to that in terms of how you landed on the average monthly rent.
Like the average, like this is a model average monthly rent. I didn't set that, but
Right.
like some of them do have bachelors, but yeah, it might bring down the or bring up the rates, but again, like it falls well below or in the range, so I think again it's fair. Like again, I think we're agreeing pretty much on NOI, so I don't.
Yeah, and although we did agree on NOI, would you agree that there's greater risk for these units that are ranging from 268 square feet to 700 square feet, renting at market CMHC rates or just below those CMHC rates, which when those units are, I believe, much smaller than average unit sizes in the city?
Can you repeat the question?
Is it, given the small unit sizes, is there more risk applying market rents or close to market rents based off CMHC for this property?
I'm not too sure.
Okay. That is all my questions.
Thank you. Mr. Fletcher, questions?
I do have one. I'm just curious on page 5, your comparables, your rent comparables. Do you know, sir, if any of those comparables are operating as an assisted living complex for seniors?
I'm not too sure.
Okay, thank you.
Ms. Penner, questions?
No questions for me, thank you.
My question, Mr. Deitchen, with respect to capitalization rates, and you may not be able to answer this, does the city distinguish or have a distinguishing feature for residences or multifamily residences run as seniors residences?
I'm not too sure I can say.
Okay.
Yeah, sorry.
Okay, thank you. I don't have anything further. Mr. Capus, any summary?
No, thank you.
Mr. Deitchen?
No, thank you.
Thank you. Then, having heard the evidence, we will conclude this matter and move on to number 7 on the list. That is street address of 571 St. Anne's. And I see there is an application for non-cooperation here as well. So, Mr. Deitchen, if you can please introduce the property, roll number, give us an overview, and then the evidence with respect to the application for non-cooperation.
Sorry, just 1 second. So yeah, this is file 26-2656, roll number 0802105450. It is 571 St. Anne's Road. And I have the non-compliance information. Should I go right to it?
Yes, please.
Oh, yeah, sorry, yeah. And that is all the way on page 13. Again, I just added in the Municipal Assessment Act, giving the information about the date mail sent and received. It is presumed to be mailed on the date or of the notice or document and is deemed to be received on the 5th day after the notice or document is mailed. Then on page 14 is just the IND mailer cover letter. You can see it was sent out April 8th, 2025 to the owner. And then pages 15 forward are just the blank INAs. Thank you.
Thank you. Mr. Pipos, do you have questions with respect to the application for non-cooperation?
Sorry, I was muted there. I do not have any questions.
Ms. Penner, questions?
No questions for me, thank you.
Mr. Fletcher?
Not at this time, thank you.
My question is going back to page 2, the history of compliance, and the compliance I'm looking at shows extension granted in 2023 and 2024. How is an extension granted? Does it have to be requested by the
I believe, yeah, I believe so. Yeah.
Okay.
Yeah.
And there was no request in your system here, or
Yeah,
no
there's
extension granted?
nothing. No.
Okay, thank you. Mr. Capust, any evidence you care to present with respect to the application for non-cooperation?
No, I understand property management changed around this time, but it appears on page 14, the city has the new property management. So I think there's I think that's as much as we can speak to there.
Oh,
It must have been
okay.
changing the system by this time, so.
Okay, Mr. Deitch, any questions with respect to that?
No.
Okay, Mr. Fletcher?
No, sir.
Ms. Penner?
No,
Any
thank you.
With respect, okay, thank you. Neither do I, then perhaps we can go in camera and consider the application for non-cooperation. Thank you. Thank you. We've had a chance to consider the application for non-cooperation, and we will be allowing the application as similar to the last property. Then, Mr. Capus, the onus will be on you, and once again, the orders pursuant to the Municipal Assessment Act will carry forward as well. Also, the evidence with respect to cap rates indicated earlier in the first one and the cap rate study that you presented, all of that evidence, questions and answers and submissions will carry forward onto this property as well. So, Mr. Capewist, if you could proceed, please.
Thank you, Mr. Chair. So the file number and roll number has been read in, so I'll proceed to on page 2. The original and effective age of the property is 2008 as per the city. The property has a gross floor area of 142,276 square feet. It's a 4-story building. There are 111 one-bedroom suites and 54 two-bedroom suites. And the site area is, I think that site area might be a typo. I think we have the proper one further down, so apologize on that. The 2027 realty assessment as per the city assessor is, there's 2 portions to this property, is 19,543,000 for the 40S portion and 2,103,000 for the 40T portion. And we are requesting for the 2027 assessments for the 40S portion an amount of 17,240,000 and an amount for the 40T portion of $478,000. Moving along to page 4, I was able to inspect this property on August 14th, both inside and outside. On page 6, we have an overhead shot of the property as well as a map. And then page 7 are some exterior photos. And now on page 8, short description of the property. It's located at 571 St. Anne's Road. It is a 4-story apartment building located on the east side of St. Anne's Road between Richfield Avenue to the north and John Bruce Road to the south. The subject property, built in 2008, has a total of 165 residential units, including 111 one-bedroom units and 54 two-bedroom units. The total gross floor area is approximately 142,276 square feet, and there are reported 125 parking stalls, which is only 76% of total suites. So there is a shortage of land as it doesn't have 100% parking. There are no excess lands that could be sold off. The subject site is irregular in shape with a total size, according to the City of Winnipeg Property and Taxation Department records, of approximately 3.5 acres and is zoned RMFM multifamily. Regarding the 40S and 40T components, sorry. So at the bottom of page 8 there, legislation does allow a maximum of 2 acres for school tax exemption. The total land is 151,422 square feet, and the 2-acre exemption is 87,120 square feet, leaving 64,302 square feet of excess land over and above the 2 acres. However, there is no excess lands that could be sold off because the subject does not have enough land to have 1 parking stall per suite. The configuration of the building and parking does not show any lands that could be sold off. Now, I can note, I believe it's been read into, doesn't have royal assent yet, but I think there's movement to have this 2 acres exemption up to, I think, 5 hectares actually, but that's not official yet. So we'll move on to page 9. Just a screenshot of the property as assessed for this cycle. And then moving on to page 14, our income approach. For the purpose of this report, we are applying a potential market gross rent of $1,916,586 or $968 per suite per month. This is based on actual stabilized income of the subject property. This would be in dispute of the assessor's potential market gross rents of $2,162,714 or $1,092 per suite per month. As we've discussed, CMHC 2024 average vacancy was quite low in the city. But based on everything we know, in our studies of the market, we've applied a market. We've determined a 2% vacancy rate as kind of a floor for investment properties. And given the actual operations at this property, we've upped that to 3%. And for an expense allowance, for the purposes of this report, we are applying an expense allowance of $887,335 or 46.6% of effective gross income. And this is based on actual stabilized expenses at the subject property. For the purposes of this report, Ryan is using a capitalization rate of 5.75% based on our study. The factors going into this, given the age of the property, it's built in 2008. Our base would start at 5%. It's a wood frame structure. The building amenities, there's a multi-purpose room on each floor, and the finishes are very basic. The durability and quality of income. This is social housing, nonprofit seniors housing. The condition we deem to be average. The parking, there's 0.76 stalls per unit. And the suite mix, it's 67% one bedroom. And as reviewed in our cap rate study, there's a lot of broader market uncertainty. There's rising costs for utilities, less immigration and temporary foreign workers and student visas, and more supply coming online. So there's a lot of factors. And again, this is a property with a lot of smaller one-bed units, so that per unit sewage cost is going to have a particularly high impact at a building like this. So we've settled on a capitalization rate of 5.75%. And now moving on to page 16, this is, excuse me, we've valued the land separately because there's not a full exemption on this portion of the land. So I can just quickly go through this. The total land area is 151,422 square feet. There's 87,120 square feet of exempt land, leaving 64,302 square feet of taxable land. The building footprint is 35,569 square feet, leaving total land not covered by building at 115,853 square feet. So now taking that 40T land as a percentage of the total land area, it's about 55.5%. So we're valuing this excess land, or this, we're valuing this non-exempt portion of land as a parking lot, as that's what it's mostly being used for. Our current market rates for parking in this area of the city is $50 for outdoor parking. So given that there's 125 stalls at the whole property at $50 per stall at a 55.5% ratio for the non-exempt land, get just under $46,000 in income, and with a rough estimate of, which is in line with parking lots, of 40% expenses, you get to a net income for this portion of the property of $27,473, which at the property cap rate of 5.75 is a value of $478,000. So moving to page 18 is our stabilization of the main property. And you can see that we've made an adjustment downward for we've deducted the unexempt land portion from the total value of the property because there is no excess land at the property. So it's contributing to the value of the property as a whole. So we valued the whole property at $17,718,000. We've deducted that unexempt portion of land, coming to a value of $17.2 million for the building itself. And then page 18 is a stabilization of R&M. And in summary, for page 19, we are requesting a reduction in the 2027 realty assessment from $21,646,000 down to $17,718,000. And page 21 follows with our appendix. There's photos from the inspection, as well as city supplied property data and the available I&E statements. And that is my presentation.
Thank you. Mr. Deitchen, have you any questions?
Yeah, I guess just quickly, you kind of touched on the Municipal Assessment Act, stating that over 2 acres would be taxable. Do you agree that it's not necessarily a specific area? It's just over 2 acres would be taxable. Does that make sense?
I believe so. Yeah, you're saying I think I
Yeah,
understand
okay.
what you're saying.
So then I guess my question ultimately, would it not be inequitable to value this property different than others that have this exemption as well under the Municipal Assessment Act?
And how are those valued?
Well, anything over the 2 acres would be valued at land only. And it's regardless of the parking and other things.
So you're, like, are you saying it shouldn't, are you asking if we shouldn't have deducted it from the value, or we shouldn't have valued it as parking, just valued it as land?
Well, yeah, both, I guess.
Right. Like, because I guess I think there's 2 things in question here, right? It's the value of the land outside of the 2 acres that are exempt. And then should it be deducted from the whole value of the property, or is it in excess and it should be added to the property? I guess we valued it as parking because that's what it's being used for, but I suppose we could also value it just based on, as vacant land. But if you look at page 6, the map, there is really no excess land. Everything is in use. It's all contributing to the whole value of the property. So regardless of what we've valued it is not adding any value to the property that we've, the operating property. So we can't double count it as the land portion and as the part of the property. So it should be deducted from the total property value. Either way, depending if you value it as parking lot or vacant land.
Yeah, sorry, that question was a little all over the place. Do you know, was this property ever valued this way, like the way that you're doing today, taking the income value off the total 40S?
I believe certainly it's under appeal at the Manitoba Municipal Board for last cycle. And I know it has been broken out into these, 40S and 40T for several cycles, but I'm not certain prior to 2025 if it's been deducted as such, or
That's all my
beyond that. But
sorry, actually, I guess just one other thing to touch on again, on your page 17, your income breakdown here. Again, the actual realty taxes paid in 2024 is $176,000. Is that correct?
Yep.
Okay, thanks. That's all.
Thank you. Mr. Fletcher, questions?
Not at this time.
Ms. Penner?
No, thank you.
And I don't have any questions at this time either. Mr. Deitchen, please, your evidence.
Okay. Yeah, so this is a 2008 building with 165 suites. On page, unfortunately, my pictures of the property got lost somehow, so we'll skip on to page 3. There are 111 1-bedrooms, 54 2-bedrooms. The total average monthly rent is $1092.28, and it is broken down to 2 portions. So the 40S has an NOI of $1,133,518 at a cap rate of 5.8%. And then the second portion, the excess land of the property Based on the Municipal Assessment Act being over 2 acres, it is about 64,000 square feet. And it is $2,103,000. And that comes to about 3270 a square foot. And then on page 4 is just my rent comparables. Again, tried to find similar building types in the area. You can see that the range is about 1,099 to 1,487, and the subject being at 1092 falls below that range. Again, on page 5 and 6 is just the Manitoba Housing or CMHC tables, sorry. And then on page 6 is the breakdown of the per suite rate and the year built. Page 7 shows the total of the combined averages and the average yearly potential rent of 2,726,262, with the model being 2,162,714, and that is about 21% lower than the market. On the bottom, page 7 is just some quick land comparables. I was trying to find some in the area, some newer ones. You can see they kind of range all over the place from $32 to $74 a square foot. And then continuing on to page 8 is the cap rate table. Page 10 is the Municipal Assessment Act. And then pages 11 and 12 are just a older mailer from the property. And that is my evidence. Thank you.
Thank you, Mr. Capus. Questions?
Yes, just a couple questions, please. Starting on page 7, I guess, for the land comparables. So I guess the land value, apologies, on page 3 of 2,103,000, that's model driven.
That's correct. Yeah.
Okay. And then page 7 are just some comparables you found to kind of give a range there. And
That's correct.
comparable 1 is quite a bit smaller than the subject. Is that correct?
Yeah.
Okay. And comparable 2, I believe that that those sites there have geothermal energy or heating there. I think that was in place prior to the sale. Would that potentially impact the price the purchaser would have paid?
I'm unaware of that, but yeah, it would. And again, it's over double what the subject is, so I think that could be in there.
Yep. And then comparison 4, I could be wrong on this, but I think that was a apartment or condo that was on fire and it subsequently sold at this date, you know, with the basement in place already after the fire. Would that influence the sale price by chance, if that's the case?
I couldn't speak on that. I'm not too sure.
Okay. And then otherwise, were you able to, you mentioned some pictures where they didn't make it through. Were you able to inspect this property?
No.
Okay. And then lastly, just going back to the land. So you valued it at $2.1 million, and you believe that value is in excess to the total property's operational valuation of $19.5 million?
That's correct.
Okay, that is all my questions.
Thank you. Ms. Penner, have you any questions?
No questions for me. Thank you.
Mr. Fletcher?
No questions, Mr. Chair.
I'd just like to revisit, and maybe you can clarify the extra land or the excess of land. The city assesses, as I understand it, the subject property with a maximum amount of allowable land of 2 acres. Is that correct?
That's correct.
And because this subject property has more than 2 acres, the excess property, which is calculated at 64,000 square feet. Is that correct? 64,000 square feet?
Yeah, about that.
So about an acre and a half roughly. That's calculated, or that's classified as excess of land, and you valued it not on an income basis, but on a sale, comparable sale basis. Is that correct? Have I got that right?
Yeah.
Okay. Thank you. I don't have anything further. Mr. Capist, any summary?
Yes, just quickly want to again, for this property, I think it's important to consider all the headwinds that were being faced at the reference date in regards to capitalization rate in terms of, there's more competition for tenants, more incentives and discounts, and a greater flight to quality. There was less immigration, more supply online, and higher costs. So I think it's very important to consider that when we're looking at capitalization rates. Thank you.
Thank you. Mr. Deitchen, any summary?
I guess just quickly about the excess land portion with the Municipal Assessment Act saying over 2 acres, the land would be assessable. I think to be equitable that we have to be consistent and do it as such. That's all, thanks.
Thank you. Then, having heard the evidence, we will conclude this matter. That now completes everything on the docket, and this hearing is adjourned. Thank you very much, gentlemen, Mr. Capist, Mr. Deitchen, for your presentations and your evidence today. Have a great rest of the day.
Take care, guys.
Thank you.
Thank you, everyone.